Hi, everybody. This is George Veter wishing you happy Valentine's Day, February 14th, 2024. Well, we've had a great start to the year, and I wanted to give you my perspective on where we sit and how things look and what's been in the news so that we're all on the same page. But I hope you and whoever your sweetheart are enjoying this holiday and appreciate those relationships. That's the real good stuff in life. Okay, first of all, talking about in the news, there's been some general themes that have been market moving. So I want to address them quickly, not bore you to death, but kind of so that we understand the perspective coming from the person you work with on your portfolios. Let's talk about inflation and what's going on with the Fed. We had really good news in December, reiterated in January, that the Fed doesn't see himself raising interest rates anymore. So Wall Street has celebrated that. Now, the Fed did say that we could expect 3 cuts this year in interest rates. So we know that we're pivoting on the interest rate cycle. Now, the question and the speculation is around when those cuts are coming. And to be honest, I'm not going to guess for you. I know that there were some people that were optimistic that it could happen as early as March. The Fed shot that down. So there was a market negative reaction to that. I don't know. Most analysts, I think I can say this fairly, is the consensus in the analyst community that forecast those things. I think it's going to be somewhere in the middle of the year. May, June, July for the first cut. I don't know. I just know that they're coming and that inflation data will determine how fast they come. So it's one of those situations that I talk about where I know how the story ends, but I'm not sure the order of the chapters. Okay, we just know good news is coming on interest rates and inflation. Now, we had a data point yesterday that the market reacted negatively to. So the year-over-year CPI, Consumer Price Index, came in at 3.1, which is the lowest it's been. So actually, we could look at that and celebrate it. The highest it was 9.1, right, at the peak of our inflation cycle, and it's all the way down to 3.1. But again, analysts were optimistic that we might have gone below 3. They were hoping for 2.9. Anyway, the data is not going to be perfect and it's not going to be linear on the way down. It's going to be choppy. We're still going in the right direction, so I'm super optimistic that the Fed has done a great job, achieved a soft landing, and the economy is expanding again, faster than anybody thought it would expand. So I'm excited about that. I heard an analyst that was speaking yesterday, and he was talking about comparing this moment with inflation and inflation fighting and inflation going down again. He was comparing it to after World War II, which made a lot of sense to me because he was talking about after World War II, we had supply restrictions, right? Because of the war effort, we didn't make stuff. We were focused on winning the war. So then when the war was over and the consumer went out to go spend money, there was a supply restriction. And when you have an imbalance, you have more demand than supply, prices go up. So we had inflation that went as high as 20% just after the war. But that ushered in a period of prosperity and expansion. We all know the end of the 40s through the 50s were great for the American economy and for the stock market cycle. And inflation went down choppy. It bounced down. It didn't go down in a straight line. I think that's very similar to today. The negative comparison would be to use the inflation spike of the 70s, where we had to fight inflation with super high rates for a long period of time, and we had stagflation, no growth and high inflation. That is not like this economy, right? We haven't had stagnation in corporate earnings or in consumer spending or anything in our economy. We are solidly in expansion by anybody's metric. So let's use the World War II comparison as far as expansion following the war due to supply concerns right after the war, high inflation that slowly went down and didn't stop the economic prosperity. I see that being a better example or a better historical comparison. Okay, let's talk real quick about earnings. Now, earnings aren't over for the fourth quarter. They started getting announced the third week in January, and most of them are announced within a month. So we're getting towards the end of earnings season. And so it changes every day as far as the percentage of companies that beat their expectations. It's never dropped below 70% that I've been able to see. I look at all the analyst opinions that track those numbers on the S&P 500. It's been as high as 78%, low as 72%, but we're having another, that's the beat rate, companies that are doing better than what they expected to do. So anything over 65% is considered to be a win. So we're having another great earnings season. We've had 4 of those in a row. Corporate earnings continue to accelerate and beat the naysayers. So I'm very optimistic about this year and continued earnings growth and the broadening of the number of stocks that are adding to expansion. You know, we had the mega cap tech stocks tied to the concept of artificial intelligence that really led the market last year and far and away created the most gains for the general stock market. This year we're having more and more and more groups, including small caps, that are helping us with our returns, which I love that. The broader the expansion, the longer it can last. Okay, I also want to talk about consumer spending. That's been a key to why the market is up. Remember that 70% of the economy is consumer spending. You know, we think, oh, it's the big corporations and what they spend that move the economy, but it's not. A third of the economy, the responsibility is corporate spending. 70% is you and I, consumer spending. Yesterday in CNN Journal, the metric was discussed that real wage inflation, so that's after normal CPI inflation, is 1.3%. So people are making more even after you account for inflation. People are making more. We know that, you know, the autos worker union negotiated that 25% over 5 years increase, but it's not just them. It's really everywhere you see. Because we had such a tight job market, people had to pay more to get people hired, and that's benefited everybody. So we've had this great period of net wage inflation that gives people more money to spend. I think it's great. And consumer confidence is up. Okay, in the same CNN Journal article, it talked about consumer confidence that yesterday measured the highest that it's been since 2021, which was the high water mark for the market previous to now. And we also have consumers feeling like next year will be better than this year in the majority, which hasn't happened since the first quarter of 2020. So between consumer spending and real wage inflation, helping people have exposure to money that they can dump into the economy to keep this expansion moving, and inflation calming down, and having earnings continue to accelerate, are a recipe for a great 2024. Now, it's not going to be straight up, but I believe the wind is in our sails and we are solidly in expansion, and there's going to be little disruptions along the way. But I couldn't be more optimistic for you and for us as a Veeder Financial Group family. I want to again just try to encourage you not to obsess on the negative part of the media. It's bigger than it's ever been because there's more media competition than there's ever been between social media and our networks and our streaming news channels. There's so many voices out there. The more outrageous they can make the negativity, the more attention people tend to give to it. I don't know why we're built that way, but that seems to be the way it goes. So there's tons of negativity. I would say limit your exposure to the negative people out there. The world's never been advanced by negative people. You hear me say this all the time, but there's never been a statue erected for a critic or a pessimist. Those people suck things down. They don't build things up. We want to be on the side of the stream, the way that we look at life. You know, I know it's an old adage, but we need to look at the glass half full, not the glass half empty. Most of the media can only see the glass half empty. What I'm showing you is the truth and how the markets can continue to build on their gains. I'm going to just leave you with a quote from Think and Grow Rich, one of my favorite books. And I'm grateful that years ago I created a discipline in my life to read positive things every day so I could keep a certain way of thinking to navigate the world through. And that's, I know, been a huge blessing in my life. But in Think and Grow Rich, Napoleon Hill says, you can if you think you can. If you dare not, you don't. If you'd like to win but think you can't, it's almost certain you won't. If you think you'll lose, you've lost. For out in the world we find success begins with a person's will. It's all in the state of mind. If you think you're outclassed, you are. you got to think high to rise. You got to believe in yourself before you can win the prize. Life's battles don't always go to the stronger or faster person, but the person who wins is always the person who thinks they can. So let's think positive. Let's read good stuff. Let's enjoy our relationships. Let's take our sweethearts out to dinner or make dinner for them. And let's have a wonderful 2024. Thank you.